Bob Boyd, you launched a floating rate loan fund back in February. It's been flat since then. So why do I want to own a floating rate loan fund now? Why should I own the FLIRT, the FLRT?
Investors are buying our fund for a couple different reasons. One is for a relatively high amount of current income. These are funds that are paying, a pretty substantial yield versus treasuries and a lot of the other investment options that are out there. Very importantly, though, is these tend to be what we invest in are floating rate assets. So investments that pay a spread over LIBOR. So should interest rates rise at some point, should the Fed finally get around to removing some of the accommodation that they've put in place over the last several years, bank loan funds tend to perform very well in rising rate environments against just about any other asset class out there.
So, for example, what's it yielding now? And say the Fed moves up later in the year, whether it be at the September or December meeting, what's it going to yield later?
The bank loan funds right now are yielding about 5.5% on an index basis. So that's reflective of a sell-off that we've seen in credit markets in general over the past several months. There is credit risk in these portfolios. So even though you're reducing interest rate risk, there is high yield credit risk that exists in these portfolios. So as interest rates rise, most funds have what's called a LIBOR floor in place. So you won't get an immediate tick up in rates, but as the Fed cycle continues, they continue tightening. Every time the Fed increases, you're likely to see 25 or 50 basis points increase in coupon over the next several quarters.
And how does your ETF differ from the ones over at First Trust or Power Shares? Yours is an enhanced fund. Tell me what that means.
The main difference in our fund is active management. The bank loan market in general is a market where you don't have a huge amount of upside, and companies do very well, they refinance, and they're not in the bank loan market anymore. Companies do very poorly, you do have that risk. But in an active management portfolio, the key is to avoid losses. So you want an active manager, you want a manager who's out actively monitoring these portfolios, looking at the individual credits every single day, and that's what our group does at Pacific Asset Management. The enhanced part of our fund is allowed to use a modest amount of leverage, and we use that in a dynamic fashion. If we're very positive on the markets, we'll use upwards or in the range of 30% leverage, so very similar to what a closed-end fund might use. If our outlook on the market going forward is not as positive, then we're not going to be using any leverage. So that's a dynamic tool that we think will add value.
Is this type of fund a good alternative to high yield? Because right now there's a lot of worries about the high yield market and liquidity problems there.
It is for investors that are looking for a somewhat less volatile investment. They're looking for yield, but not as much yield, not as much volatility as the high yield market. From an interest rate, a duration perspective, you're getting significantly less interest rate risk, but high yield is yielding significantly more. If the market does very, very well, you'll do better in those high yield investments.
Is there enough liquidity in the bank loan market?
There is. There's one of the big challenges in liquidity. There's two aspects of it within the bank loan market. One is tradability, the ability to go out in the market and execute a buy or a sell order. That liquidity is quite good. And in our fund, in FLRT, we focus on the largest, most liquid names in the market. So that makes it even easier as far as liquidity standpoint. The challenge, the unique challenge that bank loans have is that they're private issues. They're not securities with CUSIPs the way high yield bonds are. So there's a longer settlement period. So in a fund like ours, we're very conscious of liquidity, making sure we have liquidity in place at all times to respond to whatever market conditions are out there.
All right, thanks a lot, Bob.
Thank you.
And thank you for watching The Street.